Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, September 24th, and global investors are served a good and a nice dose of monetary stimulus measures from around the world to keep running up a mountain, except in Australia, where the Reserve Bank of Australia kept its rates unchanged today, and its chief said that they don't care about what the other central banks do. So support from the world's major central banks and the dovish expectations continue to rise this week. After lowering its 14-day reverse repo rate yesterday, the People's Bank of China announced today that it will lower its 7-day reverse repo rate from 1.7 to 1.5%, and its reserve rate, so the amount of money that the banks should keep aside, by 50 basis points to unlock around 1 trillion yuan in hope to boost growth in China. So that's a lot of measures announced all at the same time, mind you, because note that this is actually the first time in over a decade that the Chinese central bank acts on both fronts, both on the repo and the reserve rate at the same time to boost appetite and hopefully boost growth as well in China that has been sputtering since a while. And they also unveiled additional support to the property sector in China to reduce the bleeding there as well. And happily for them, investors reacted positively this time to stimulus measure news, sending the CSI 300 index near 4% higher at the time. I'm talking here, the Hang Seng index soared nearly 4% as well today and gained more than 10% since the middle of September and more than 15% since the beginning of August. So that's great, but the rebound in Chinese assets will likely remain fragile as well. The tensions between China and the West actually remain quite unpleasantly high right now. And according to a chart that I saw recently on Bloomberg, while the trade tensions between the US and China are expected to weigh badly on Chinese growth prospects over the next couple of years. Voila. That's it for China. Then, in the US, a few Fed members spoke on Monday, and they actually spoke to back the idea that further interest rate cuts, and maybe big ones, are on the horizon in the US. In this respect, the very Neil Kashkari expects 2 more 25 basis point cuts from the Fed this year, while the Chicago Fed head, Austin Goolsbee, thinks that the Federal Reserve's current policy rates are hundreds, he said, hundreds of basis points above the neutral rate, and that the Fed has a long way to come down to get the interest rate to something like neutral to hold the conditions in the US where they are. Of course, no one knows where the neutral rate is, otherwise it would be just too easy, but the central bankers are quite dovish to say the least. So that's the central bank leg of the story. Then there is the data leg, of course. That's more mixed because released yesterday, the S&P's PMI data showed that the economic activity in the US grew in September, but grew at a slower than expected pace by analysts. Services did okay, but the slowdown in the US manufacturing accelerated. So the mixed set of data demoralized less than the dovish Fed expectations boosted appetite. So the US 2-year yield remained below the 3.60% level yesterday. The S&P 500 consolidated near an all-time high level. Nasdaq 100 and the Dow Jones Industrial Index were both bid, but only the Russell 2000 and oil didn't see enough demand to carry their prices higher at yesterday's trading session, despite quite a positive sentiment in the equity markets altogether. And that's quite interesting, especially for oil that had a rough day yesterday, because not only that, the bigger interest rate cut expectations from the Federal Reserve, and also news that the Chinese authorities cut their reverse repo rate to boost liquidity and to support growth in China. well, couldn't actually lift mood among the oil bulls yesterday, but even the rising tensions between Israel and Lebanon couldn't get the oil buyers back on board. So the barrel of US crude actually lost more than 1% on Monday's trading session. Now we see some support this morning above the $71 per barrel level, and that's on the back of further stimulus measures that were announced from China earlier today. But the black gold's inability to rebound, or its timid rebound on rising central bank support from around the world, and also the seriously mounting geopolitical tensions in the Middle East, actually raises questions regarding its ability to unlock the upside potential. So strong resistance is still in play near the $72.85 per barrel level, which is the major 38.2% Fibonacci retracement, which should actually distinguish between the continuation of the actual bearish trend in oil and a medium-term bullish reversal for an eventual return toward the $75 to $77 per barrel range. The yellow gold, on the other hand, was catapulted to a fresh all-time high level yesterday, and that was on the back of soft US yields and rising demand for safety of gold due to the rising geopolitical worries in the Middle East. Now, looking at the technicals there, the RSI indicator flashes overbought conditions in gold, suggesting that the yellow metal may have been bought too rapidly and in a too short period of time, and that a downside correction, even a minor one, would be healthy at the current levels. Yet confusion regarding whether the stock markets actually deserve to advance toward fresh record high levels, while the Federal Reserve is rushing toward exiting its tightening policy. And the tense geopolitical setup around the world could help gold bulls overlook the overbought conditions in the market for at least a little while. Now, coming back to the central bank talk, yesterday's soft set of PMI data from the Eurozone countries also revived the European Central Bank dose on Monday's trading session. The latest data actually show that Euro area's private sector shrank, and it shrank for the first time since March, and the deterioration in German manufacturing unfortunately accelerated, and French services slipped into the contraction territory in September as the positive vibes from the Summer Olympics in Paris continue to fade. So the soft economic data from the Eurozone revived the idea that the European Central Bank could and should cut more roughly to give support to the sputtering European economies these days. So in response, the euro-dollar sold off heavily yesterday. The pair tipped a toe below the 1.11 level, but rebounded above this level this morning as the US dollar bears came back in charge rapidly again. Now, the French and Spanish CPI updates are due to be released on Friday this week, and sufficiently soft figures will likely keep the euro sold, even against a weakened US dollar across the board. Now, there is one central bank out there that stands out in the middle of a jungle of those, and that's the Reserve Bank of Australia. So the RBA kept its policy rate unchanged for the 7th consecutive meeting today, and its governor said that they do not care about what the other central banks do, that they are actually focused on their own domestic economy, and that the board wants to see inflation in Australia come firmly back to the 2 to 3% range, and that they were not expecting to cut their rates in the near future. Well, that's pretty clear, I think. The Aussie hit the highest level this year against the greenback, obviously on the back of this clear divergence between the Reserve Bank of Australia, which actually refuses to cut rates before it sees inflation under control, and the Fed, where the bankers rush maybe prematurely toward rate cuts because they are now more focused on the economic growth. Now, note that the Chinese stimulus news also have the potential to give a boost to iron ore futures and to the Aussie. Yet iron ore bulls look like they won't clap before they see concrete positive results from these Chinese stimulus measures on all the actual economic data from China. But on the other hand, it is true that supportive factors are gathering to pave the way for a further Aussie strength against both the greenback, the euro, and the Japanese yen. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow and until then, good day trading.